Good afternoon, everyone. Thank you for joining us for this webinar. We have three panelists on the webinar that I'll introduce here shortly. Today's topic, we'll be talking about the cardiology sector and some of the private equity investment activity that we've been seeing and considerations groups should have as it relates to both legal and investment banking considerations. With me, I have two directors from Provident Healthcare Partners, AJ Shaker and Ethan Goodson. My name is Eric Major. I'm a managing director with the firm. Provident is a boutique investment bank with offices in Boston and Los Angeles. We represent exclusively healthcare services groups through transactions, and specifically over 75% of our deals in the last several years have been with physician groups. We've closed transactions across over a dozen different specialties and have been very active within the cardiology sector. So we're happy to share some of our insights of what we've been seeing within the space. Also have Angela Humphreys. Angela is the healthcare practice group and chair and co-chair of the healthcare private equity team at Bassberry. I'll let Angela give a quick personal background and background on Bassberry as well.
Sure, thanks, Eric. As Eric said, Angela Humphreys, I am chair of the healthcare practice and co-chair of the healthcare private equity team at Bassberry and Sims. I have practiced law for 25 years, exclusively in the healthcare M&A space, and am spending about 70 to 75% of my time working on transactions in the physician practice space. Bassberry and Sims is the third largest health law firm in the country, and as a result of that, we are seeing a lot of activity around private equity investment in the healthcare space, particularly in physician practices such as cardiology. So thanks to Eric and the Provident team for allowing me to participate today.
Great. Thanks, Angela. I think one of the first topics we want to touch on is just the recent trends we're seeing within the cardiology sector. It's been one of the last specialties to really see private equity activity. We have seen historically, obviously, hospitals and health systems were the primary consolidator within the cardiology sector. There's also been other groups such as National Cardiovascular Partners, which is a division of Fresenius that has been partnering with primarily cardiovascular groups over the last several years, but we really haven't seen a lot of private equity activity to date. In the last year and a half, though, there's been three transactions that have closed, notable deals that have closed with private equity, including Varsity Healthcare Partners closing a platform within the sector, Ashlar Capital and A&M Capital as well. We've been hearing on our side that there's at least a half dozen deals, if not more, actively on the market with groups that are looking at strategic options or private equity firms. Maybe Ethan, can you just touch on what's been the main driver behind the heightened interest that we've been seeing within the cardiology space since the beginning of 2020?
Yeah, so thanks, Eric. I think there are three main factors that are driving the interest in consolidation and then why now. One is the low industry concentration, which you alluded to, with only 2 or 3 platforms. There's still a lot of opportunity for private equity to build platforms that consolidate, which is frankly their business model to get those economies of scale. Two, just the overall demand and growth in the cardiovascular market. The diseases of aging are still huge drivers of cost for the healthcare system, upwards of 150 billion annually spent in the market. So that's a very large TAM, or total addressable market. And three, I think what has changed in recent years is the trend toward provision of cardiovascular services in an outpatient setting. And that is probably what is the game changer in the drive to consolidation. And within that, there's probably 3 other sub buckets of drivers of note driving that. One, I would say the advancement in technology, the ability to do percutaneous coronary interventions with a much smaller incision allows you to do many more procedures in the outpatient setting. By 2015, about 40% of all cardiovascular procedures were approved in an outpatient setting. In 2020, that's up to 60%. And then thirdly, as we see this setting shift approval, coming first from government, from Medicare. It's the cost savings experienced by both government and commercial payers, in some cases upwards of 50%, which is what I think gives people certainty that there will be this shift occurring. I mean, it's not going to happen overnight, certainly, because this remains a sort of a core competency for the hospital systems, and this will involve ultimately share shifting away from them, in these higher acuity procedures, PCIs, AICDs, electrophysiology, things like that were traditionally only done in the hospital are now going to be shifting and already are shifting over to the ASC. So I think that's what's changed about it, Eric, to your question, is the drive coming from the top, frankly, from Medicare to CMS to lower costs. But that's, and then the opportunity to consolidate within that overall reimbursement tailwind and setting tailwind.
Yep, that makes sense. And Angela, anything you wanted to add just from your perspective, maybe on the regulatory side or other factors that you think are driving the interest in the space?
Yeah, I mean, I would agree with what Ethan said. I mean, there's clearly, from a reimbursement standpoint, a shift to the outpatient setting. I think I read that currently there are now over 20 cardiology codes that can be performed in an outpatient ambulatory surgery center setting, and the differential in an ASC setting compared to having been performed in a hospital would be over $1 billion just in terms of cost savings to the system by being able to push those procedures to an outpatient setting. So I think there's a lot of opportunity there for private equity firms who are looking to make an investment to capture that and to capture other ancillary revenue streams. In addition, I would say that there has been for some time and continues to be a push towards value-based care and managing episodes of care and bundled payments within the cardiology space, similar to what we've seen in the orthopedic space. And so I think both of those trends are only going to continue. I think we're going to see increased reimbursement in terms of the number of procedures and codes that can be performed in an outpatient setting. And I don't think the shift to value-based care is going anywhere. If anything, it's going to continue.
Great. Thanks, Angela. The next topic we want to touch on is key considerations for both investors and private and practices when they're considering a transaction within the sector. Angela, from your perspective, what are some key legal considerations a practice should have and its shareholder should have prior to exploring a transaction process?
Yeah, so there are many. I think that it's very important for a physician practice considering a transaction to make sure that they have buy-in and adequate buy-in across the stakeholders in the group. There can often be differences of opinion between physicians in the group who are earlier in their career versus those who are at the end of their career, and having broad-based support among the physician shareholder base is important because any private equity investor is going to want the substantial majority of the physicians to sign up for at least a 5-year employment agreement in our experience. And I will say that there are some things that you can do on the front end in terms of the economics of the practice and how you can work within your structure to adjust for expectations across the shareholder base. And so those discussions are very important to have early on. Also, understanding where a practice sits in terms of its tax structure is very important, because there are some tax planning steps that you can take on the front end of a transaction. If you're paying attention to those things that can help you on the backside of the transaction. And then obviously, you know, proper advisors, financial and otherwise, to help you navigate the process. It can be very daunting for physicians who you know, still need to practice medicine for their day jobs. So I think a lot of work on the front end of the process can result in you know, getting the support you need from the physicians and helping you, you know, set the stage for a smooth process with a great outcome.
Thanks, Angela. And just one note, we appreciate the questions coming in. We will have time towards the end. We'll tick through as many as we can, but continue to send those over. Next question, I guess, for Ethan, if you're thinking about a practice in kind of evaluating the value drivers and risks in the eyes of an investor, what are some of the points that come to mind in the cardiology space?
Yeah, some are definitely specific to the cardiology space. Some are sort of just general to practice management, investing deals altogether, and obviously curious of the others we've seen as well. But some of the things that come to mind, you know, for value drivers, you sort of always start at growth, and there are a couple different vectors that you can think about for growth. One traditionally has been the ability to recruit new cardiologists to the practice, which I think speaks to sort of the general reputation of the platform, if that's something that the practice is able to do successfully. Any sort of expansion of locations, whether that's de novo office settings or OBLs, or obviously ASCs now, you know, top of mind for everybody on ability to do that with either independently or a JV with the hospital, and sort of expand the sort of the menu of services, you know, so to speak. Is it vascular? Is it interventional? Is it all of the above? Is it you know, diagnostic or therapeutic? I mean, all of the greater the menu of services, the more attractive and the more diversified the revenue streams. You know, in terms of I mean, one of the things on the revenue side is an ability to particularly get traction with the commercial payers around the you know, the setting shift going on to the ASC, if there's a new ASC being built or having been built, and certain states have, you know, commercial payers that are more or less progressive and willing to cooperate. You know, in terms of risk, I would say, you know, if there's a hospital system which is sort of a dominant employer of primary care physicians in the region, I mean, I think that would draw, you know, interest from an investor. If they're sort of, you know, the referral stream is controlled by the hospital system, and alternatively, you know, if there's a cooperative and progressive hospital system, that could also be you know, a value driver, an ability to sort of hospitals that sees sort of the future is coming and sort of the setting shift and wants to cooperate with the cardiology practice. That could also be, you know, a value driver. But curious, you know, AJ and Angela, what else you've seen out there as specific risks and value drivers?
Yeah, Ethan, I think you touched upon a lot of good points there. I think ultimately a key value driver in the eyes of the potential partner as well is, you know, the ability for the practice to have the infrastructure in-house to sustain that future growth model. What pieces are in play from a physician leadership standpoint, who's directing the clinical protocols going forward, who has the expertise from a recruiting and retention standpoint to create a clinical environment that can be sustained across a much larger platform. And then from a non-physician standpoint, what pieces are in play from an operational perspective, financial perspective, and even other areas like marketing, revenue cycle, et cetera, that not only can adequately service the need of the current business as it stands today, but also the ability to sustain a much larger business down the road as well. I think ultimately what becomes value additive in the eyes of the cardiology practices out there is that, you know, it's important to have some of these pieces in play and kind of demonstrate that forward thinking you know, attitude towards the infrastructure needed to support a larger business, but something as well where we've seen PE groups that have a number of repetitions within healthcare services and within practice management in particular, being value additive to those practices in terms of bringing some resources to bear that can supplement the core team as well.
Yeah, and I agree, AJ, and I think, again, with the continued push towards value-based care, having those resources to bring to bear is just going to continue to be more and more important as we mature into and continue to live within the confines of that system.
I think the next topic was actually a question that came up as well, just in terms of the different compensation models we've seen so far within the cardiology space. I think it's relatively early on in the consolidation, and obviously I think investors are still trying to figure out what is the compensation model going to look like as it relates to creating the adjusted EBITDA for these deals. I think we've seen in the early stages, that similar to other specialties, there seems to be two common models that we're seeing, one of which is more of a percentage of collections model that includes, in this case, professional fees and the technical fees from office-based labs as well, which is a production model that I think we see in a lot of areas like ophthalmology and dermatology, to name a couple. We've also seen scrape models as well, so similar to what we see in areas like urology and gastroenterology, where private equity firms are effectively, buying a percentage of the pre-partner compensation, typically around 30%. AJ, do you want to just touch on, from your perspective, what are some of the differentiators between these two models, maybe the pros and cons from the context of a physician and or an investor?
Yeah, happy to, Eric. Like you mentioned, it's early innings in the cardiology consolidation paradigm, where there isn't kind of one set model. That's the prescribed model of physician compensation normalization, and that's a pro and a con in of itself. The pro is, some of these compensation models can really be tailored to the group's culture and how they've historically done compensation, and some flexibility therein. But at the same time, for groups that may have, let's say, a number of different approaches, even internally among, subspecialists or among pods or things like that, perhaps some challenges in terms of taking what their current compensation model is and kind of fitting that to what a post-deal scenario looks like. But like you mentioned, kind of two major compensation methodologies we're seeing take hold are the percentage of collections, which, again, productivity based and revenue focused in nature, where it kind of fits the needs of the private equity group, where they want to incentivize, obviously, producers who want to maximize their patient volumes and work as much as possible to still see the benefit from that from a compensation standpoint. And thinking about broader growth strategies as well, considering the potential benefits of, let's say, payer rate improvement or value-based care dollars coming into the practice as the business grows and scales, the partners being able to benefit from that as well. I think where we see certain limitations to that are if, let's say, the practice hasn't necessarily been on a percentage of collections model in the past, and there may be significant variances in, let's say, productivity among partners that may have equal ownership at the end of the day. And so it becomes a question of who gives up what and gets X in return from a proceeds standpoint out of a deal, in which kind of we've seen the scrape methodology that you mentioned, where it's considering total earnings, revenue less expenses before shareholder comp, and then ascribing some remittance percentage to that, 20%, 30%, 40% in some instances, as kind of the proxy for profitability that would be sold with the deal. In that case, we've seen, similar, alignment of incentives in terms of the ability for the physicians to participate in upside growth in terms of overall revenue generation, but at the same time being cognizant of, let's say, the expense profile of the business as well, because those practice level expenses have a direct impact on the shareholder pool that's available for compensation as well, which may be different in the percentage of collections model, where there isn't as much of a focus on ensuring that the expenses are kind of efficiently handled on a day in and day out basis. I think, in terms of the scrape methodology as well, perhaps a little bit more, latitude in terms of how the physicians may be able to take that earnings pool and distribute it among themselves for compensation going forward, albeit a little bit more involved in terms of ensuring that there's adequate reporting to the physicians on a monthly basis to ensure that they're able to kind of divvy up those shareholder pool dollars in an appropriate fashion. But ultimately, I think it's important for any cardiology practice to kind of work through this compensation normalization exercise with their advisors, because part one is ensuring that the model fits well with the ethos of the group. But the second part is, ensuring that whatever the compensation formula is, it provides a level of competition to the market rate, and hopefully slightly higher than that can enable, sustainable go-forward recruitment as well. As we see with a lot of these physician practice groups, and cardiology is no different. There tends to be an inverse relationship between the amount of compensation sold in the deal and the level of proceeds as well. And so it's a fine balance of making sure that whatever go forward shareholder comp is, that it's competitive to the market rate while still creating enough EBITDA, enough profitability for the practice to be interested in transacting as well. And so I think as of now, there's certainly a number of different options to consider, and there's probably even variations within those two models that we described, but something that ultimately also creates some flexibility in the eyes of the potential partners, that both from a private equity standpoint, but a physician standpoint, in terms of identifying something that can not only solve for the deal today, but be sustainable going forward as well.
Yeah, I think sustainability is a key point there, is making sure, obviously, where health systems are a big employer within the space, making sure compensation is at least at that level, if not higher, so that groups can, continue to retain and recruit good physician talent. I know, Angela, if you had anything else just on the physician shareholder compensation side, anything you would add from a legal perspective?
Yeah, I mean, I think evaluating and understanding the historic compensation structure is important. To AJ's point, it goes to the culture and buy-in of the physicians. I have found in specialties that are like cardiology and others, giving the physicians latitude through, I believe you termed it the straight model, AJ. I think we would call it more of the partnership model, where the physicians continue to function, whether it's through a clinical governing board or some sort of medical executive committee, continue to function to be able to have more latitude in terms of distributing compensation among themselves within the group, continue to have insight and input in terms of protocols and things that can impact that compensation structure, to continue, honestly, to be able to, quote, make partners within their physician group. All of those things can be selling points, such that I have seen that the partnership or straight model function really, really well in some of these more surgically intensive specialties, if you will.
I think next topic coincides with one of the questions we had as well. Obviously, this sector, is a lot different than other specialties, like ophthalmology and dermatology, where hospitals are not really formidable players. Probably a lot more parallels here to areas such as GI and urology, where health systems have been, consolidators over the years and have, presence in many markets across the country. But Ethan, from your perspective, what are some of the dynamics groups need to consider as it relates to, relationships with health systems and commercial payers within the market, and how might that impact a transaction?
Yeah, so I mean, I think that there are different options in terms of investor groups targeting different flavors of the sort of the relationship or the independence or affiliation with hospital systems. I mean, there are also sort of key regional differences in the country that are worthwhile to consider. If 75% of the overall physician base in the East Coast is affiliated with a hospital and 2/3 nationally of all cardiologists affiliated with a hospital, you're looking at sort of 80–90% of the cardiologists on the East Coast being affiliated or employed some way by the hospital, versus in the West, it's just a little bit of a different model, not as many dominant health systems out here. And again, I don't think it precludes a transaction one way or another. There are certainly investor groups that we've come across who are looking to invest in places where there are, progressive health systems that do employ a lot of the cardiologists in the market, but are looking to sort of get ahead of the changes that are coming. And then, on the other side of the spectrum, you have investor groups that are looking to target cardiology practices that are more or less independent from the hospital systems. I mean, everyone does sort of get affiliated in some way, whether that's doing call or have privileges, but I mean, there's a spectrum of affiliation with the hospital systems, depending on the sort of the specific regional market that we're talking about. So, I mean, there's no sort of one answer of right or wrong. It's just sort of understanding the dynamics and targeting the right investor base. And I think the other thing that comes into play here is, the value-based care considerations that Angela has brought up 12 times, which I think are on point. And, how that plays out over the next 20 years. I think we're all sort of awaiting the specifics. One arrangement that people are exploring are, subcap arrangements with cardiology practices, with hospital systems potentially. So that's another factor to consider here in sort of the relationship with the health systems and the commercial payers.
Yeah, and I guess just to further that, so obviously as groups are starting to potentially explore opening surgery centers, how do they potentially, tiptoe around that relationship with the health system to the extent it's an important referrer? I don't know if anyone has any comments just around what they've seen within the market.
Well, I mean, one possibility that we've certainly seen in other specialties, Eric, would be doing a tri-party joint venture with the hospital, physician practice management company, PE investor with the physicians, with the hospitals to bring the hospital into participation in the ASC setting.
Agreed. That's something that I think we've seen, in cardiology so far. Some groups that are reliant on the health system for referrals to keep that relationship going, just providing equity, partnership opportunities there. And then in some cases where less reliant on the health system, exploring building a surgery center that remains physician owned, that obviously could be become a partner with a private equity firm. And just thinking about, on the topic of structure, AJ, we've talked a little bit about some of the options groups might have, and obviously have focused predominantly on private equity. Can you just touch on maybe some of the other options groups have, and even in the context of private equity as well? What are some of the benefits and limitations as you consider some of the options groups have between looking at a hospital partnership or even leaving the health system to the extent the group is employed by them, looking at private equity, strategic partners, as well as just staying independent?
Yeah, happy to. I think, as you mentioned earlier, Eric, a lot of the consolidation historically within cardiology has been health system led. And some of the benefits that groups that have partnered up with the health systems have seen, it may be on kind of call it the revenue or payer side of things in terms of getting the benefit of kind of health system rates, whether that be for professional services or also from ASC or facility-based services as well. Potential for access to additional ancillary services, especially given the capital expenditures needed to build out, let's say, an ASC or a lab or pharmacy, whatever the case might be. And just overall kind of removal of some of the administrative burdens that tend to be a key pressure point for physicians just across the board. Being able to leverage that health system infrastructure from an HR, a billing, accounting function, finance, et cetera, were all historically key reasons for some of these affiliations and partnerships, some of which may have been kind of 100% buyouts or some sort of PSA type arrangement. And I think from a kind of succession planning perspective as well, I think a lot of groups that may have been smaller, independent, may not have necessarily had associates that wanted to become partners in those businesses, being able to have a solve for a transition of ownership outside of just simply closing the doors by any means. So I think what we've seen develop over the past 10 years or so with a lot of physician practice alignment with private equity firms has been the ability to, let's say, have a consolidation play, see a lot of the similar benefits to the health system alignment, while at the same time preserving elements of private practice and equity ownership and physician governance at the end of the day. And so, over the past, 18 months or so, we've seen that acceleration that you mentioned of private equity becoming increasingly an option for groups that wanted to retain, a lot of those equity ownership components and physician governance components going forward. Obviously, access to capital to build out some of those ancillary services themselves, take the current model that they may have and expand it over a larger geography, but also gaining some of that expertise in terms of building that infrastructure to sustain future growth, leveraging best practices that a private equity partner has put together from numerous past investments. Capabilities from an M&A standpoint to expand via acquisitions as well can be a key, function of groups opting for the private equity model, albeit at the same time, likely taking some time to build that scale and revenue cycle business intelligence functions to achieve payer lifts, gain a bigger piece of the value-based care pie. But finding that partner, I think, is critically important to help grow equity value and grow physician compensation under the private equity model. I think at the same time, private equity isn't an option for everyone, especially being a platform investment, just because there may be certain elements of the business, whether that be from a size perspective, whether that be from having an adequate level of internalized infrastructure or leadership to stay with the business post-transaction, that may be hindrances to practices being able to be a platform in their own right. But I think what's going to be interesting over the next few years is, especially with private equity groups aligning with platforms across a number of regions in the country, the emergence of more of the private equity backed strategic here that may be able to fill some of the form and function of what health systems have done in the past, in terms of offering, let's say, immediate synergies in terms of payer rates, access to ancillary services, removing some of that administrative burden, while still keeping in place equity ownership for physicians, transition plan for, let's say, older physicians, and pathway for ownership for not only associates, but potentially also key management as well. And while there are, call it 3 groups that have taken on private equity investment, and it's been kind of clustered regionally, the intelligence that we've been kind of hearing in the market is that there's several processes underway, likely several more groups that will become private equity platforms in their own right, and something that will likely be a greater element to consider for groups outside of just, let's say, becoming a private equity platform or aligning with the health system. And I guess at the end of the day, there's always the option to stay independent, whether that be groups that want to undertake, let's say, their own value additive projects before doing a deal, growing through their own resources and access to capital, albeit comes with execution risk and personal guarantees. Obviously, greater exposure to macro elements in the economy, but I think everything that we're seeing is that cardiology stands to kind of replicate a lot of the consolidation patterns that we've seen in some of the other single specialty and surgically focused specialties out there.
Agreed. Thanks, AJ. Maybe just from Angela's perspective, and certainly can be specific to cardiology, but also just thinking about healthcare as a whole. What's your outlook just in terms of any healthcare policy changes and tax changes that groups should consider under the new administration?
Yeah, so certainly 2021 is the year of the deal. If you're a physician practice, we've had a number of deals launched recently where people are looking at the proposed tax changes and wanting to do a deal in 2021. There's talk that the increase in capital gains rates could be retroactive back to the end of April. I believe that remains to be seen. But notwithstanding that proposed retroactivity in terms of a potential tax law change, people seem to be interested in going ahead and getting deals done this year, thinking I think that perhaps everything that is proposed in terms of the tax law changes won't come to fruition, and we will settle in some sort of middle ground, not exactly where the administration is proposing. And then in terms of legislative and policy changes around cardiology, I think one of the questions that was submitted is what's next? What are the next codes that are going to be added around reimbursement? So the PCI codes, I believe there were 6 added for 2020. And I think when you look out to 2022, 2023, you're going to continue to see additional codes added for reimbursement in the outpatient ambulatory setting, including cardiac mapping, ablation procedures, and other procedures. So I think the opportunity there is only going to continue to improve.
Great, thanks, Angela. And I think we've had a couple questions too, just around the OBL versus the ASC. I know, Ethan, we've seen obviously some different models out there. Some groups that didn't have an OBL that have opened a surgery center. Some groups that are using more of a hybrid approach. Any commentary just around the dynamics between an OBL and the surgery center?
Yeah, so I think maybe the question trying to read into it, I think, is many procedures are approved for both the OBL and the ASC setting, and there's totally different reimbursement in each of those, and where should you put the setting for the procedures? I think sort of just taking it back to first principles, what's important is delivering the best clinical care to the patients with the highest quality and the highest safety, and I think it's maybe sort of even stepping back further. A lot of the data that we're seeing is that the ASC, not surprisingly, is at or superior to the hospital system. Certainly, COVID also has impacted this with the sort of the onerous level of testing that's required often to get into hospital systems, apparent, depending on whatever state regulations are at play, versus an ASC, typically a little bit more easy for the consumer. And then obviously traditionally HIIs are always a concern in the hospital setting. So, I think starting there, what is best for the patient in terms of some of the procedures that can be reimbursed for both the ASC and the OBL. I think we're getting pretty far into the weeds, if that's sort of the crux of the question. I will comment that maybe this is also around sort of the hybrid model, and maybe certain days of the week it functions. That's the ASC, certain days of the week as an OBL. We haven't seen the hybrid model as much as maybe we would have expected. I think people, for the most part, in terms of the clients that we've worked with, have, had freestanding OBLs separate from ASCs. And maybe it makes sense as you think about the sort of the trend toward sort of utilizing and building capacity as preparing for that sort of the shift to come over the next 10, 20 years. That's maybe why people haven't adopted the hybrid model as much. So those are some of my kind of thoughts on that question on the spot. I'm not sure if that addressed what the questioner was asking. I should just make the commentary that all of our contact info, maybe this was already said at the outset, Eric, Ethan, and I think Angela as well, is on our website. So if there's any specific sort of more in the weed type questions, please feel free to reach out to any or all of us.
And we'll continue to tick through some of these questions that have come in, but did want to just provide some closing thoughts before we get to the rest of the Q&A. I think, we've seen the space, as relates to private equity interest. I think we're in the very early innings. A lot of people like to use the innings analogies as it relates to where a specialty is in the context of consolidation. And I would definitely say we're still in the top of the first inning in cardiology as it relates to at least private equity-led consolidation. Obviously, health systems have been consolidators now for a long time. Just market sizing, we view this sector as probably not going to get to the same number of platforms as an area like ophthalmology, given you have such a big hospital presence and a large percentage of the cardiologists in the country are part of health systems already. But you do have over 30,000 cardiologists in the U.S. So if you kind of factor in the hospital employed cardiologists and view that comparable to other specialties, we still think that there's room for at least a dozen platforms. And if you look at areas such as urology and gastroenterology that are much smaller in terms of the number of specialists within those areas, and they also do have an employed presence. We're seeing, GI is almost up to about a dozen platforms now. Urology is about a half dozen platforms and is still pretty early stage. So I do think cardiology probably gets to at least a dozen platforms. And based on what we're hearing in the market, there could be upwards of 6 to 7 platforms at least by the end of this year. So I think there's plenty of opportunity for investors to get into the sector, and for cardiology practices, very early on in the consolidation play, where we do expect that this private equity activity is not going to go anywhere. If you look at other specialties, when you're in the first 1 to 2 years of private equity activity, there's usually a lot of scrutiny, a lot of skepticism in the market from the physician owners themselves, who don't believe that the private equity model will take off or will have, will work within their particular sectors. But oftentimes that's proved wrong over a period of 5 to 10 years, as we'll see some very large platforms emerge across the country. I think focus probably regionally, at least initially, and then expanding into more of a multi-regional play. And I think in the very early stages of that consolidation, we already are seeing some groups that have platforms that they're closing in the sector. They're also looking at potentially other co-platforms in different parts of the country. So we do anticipate that this activity will continue to pick up its pace over the next 6 to 12 months, and private equity activity should be a pretty regular topic within the cardiology space, just like we've seen within other specialties. I don't know if anyone else wanted to provide any just concluding thoughts before we get into the questions.
Well, I mean, Eric, I would say, I think it's a great opportunity for private equity investors and the physicians. But when you look at this specialty and the ability to manage value-based care, and then also to take advantage of ancillary revenue streams and service lines that particular cardiology practices may not have today, I think it's an investment opportunity that is very attractive to private equity in terms of an investment thesis.
Cool. Yeah, I think maybe some questions we can tick off. One of them, someone asked about just valuation multiples in the space. I think it's obviously very early on. There aren't many precedent transactions that you can point to within the sector. You can probably, at least what we would do on our side, is kind of look at comparable businesses within other specialties. But maybe AJ or Ethan, any just general comments on what we're anticipating in terms of multiples? I mean, I would imagine we'll see things pretty similar to what we're seeing within other physician specialties.
Yeah, I mean, I think that you always sort of start with growth when you look at multiple. Multiple is basically a Condon's version of whatever the future cash flows of the business are discounted back. So certain businesses have greater growth features. So it's always hard to generalize. I would say that getting into the double digits for the larger and platform-esque practices is certainly something that we have seen and expect to continue to see. I think over time you would even expect these sort of the add-ons to increase in multiple as well. There's usually a bit of an earlier mover advantage for the first platforms, and sort of that spread or arbitrage would narrow. But that's sort of what we're seeing out there, in the market, and frankly, talking to the people who are now participating in these half dozen other auctions.
Thanks, Ethan. I think another question, just how do groups think about handling retiring doctors and maybe associates that are on a partnership track? AJ, do you want to just touch on maybe some of the models we've seen, and then we'll let Angela add as well?
Yeah, happy to. I think this goes back to some of the points we were discussing earlier about sustainability going forward. So we've seen a number of different methodologies to handle some of those retiring physicians, and at the same time ensure that new associates who have a long tenure with the business going forward are adequately incentivized with the deal. I think that the typical things that we see are from a allocation of cash at close to rollover equity. And what we generally see is that for those, let's say, retiring physicians who may not necessarily be contributing significantly to the growth of the business over that 4 to 7 year horizon that the PE firm would be invested, those individuals taking perhaps more cash at close, whereas the younger partners who have, let's say, at least the second bite of the apple in their horizon, but potentially the third down the road, having a greater portion of equity as part of their overall purchase price allocation. Obviously, one thing to consider with the help of Angela and other tax experts is ensuring that that's all handled in a way that's tax efficient and won't cause undue burden on the business going forward. And I think at the same time, from an associate perspective, those individuals, may be coming into the business and into the deal at kind of a unique and sensitive time where some individuals, let's say they were offered shareholder pathway as a result of the deal, and maybe a year or so out from becoming full shareholder status, reserving, let's say, some portion of the proceeds of the deal to, let's say, either kind of bonus out those individuals or allow them to buy equity into the business. And I think one aspect from a compensation standpoint that might, steer people more towards, let's say, the scrape methodology is allowing individuals to, let's say, partner into that practice shareholder compensation pool that stands to grow over time with the business performance, and essentially being able to be compensated as a shareholder in addition to getting the benefit of potentially transaction proceeds at close or rollover equity that can be bought as part of the deal. I think increasingly we've seen equity grants to be less likely for those individuals, and again, something that Angela may be able to comment on in terms of proper incentives and the legality around it, but certainly something where I think the crux of a lot of these discussions with associates is allowing them to have some sort of win with the deal, either some bonus at close, but certainly pathway to equity ownership and shareholder capabilities in some way, shape, or form. Angela, not sure if that kind of rings true with what you were thinking as well, but you may be able to provide some more nuance on kind of the legal structuring elements of it as well.
Sure, it does, AJ. And, I mentioned early on that understanding your tax structure as a physician practice is very important in connection with the transaction. And, through some reorganization moves on the front end of a transaction, we've been able to reorganize some practices to be able to reallocate ownership and units of ownership within a physician practice to be able to deal with the expectations across the spectrum of shareholders in terms of proceeds and rollovers. There is a structure where you can accelerate a physician's ownership in the practice, someone who's on a partnership track, and be able to award him or her units of ownership in advance of a transaction, and depending on the tax structure, allow him or her to still, maintain long-term capital gains treatment on the transaction. So those are some things that you can do in terms of planning and reorganization on the front end. Also, we have seen physicians who, as you mentioned, receive bonuses, who are allowed to, buy in equity in the new platform with after-tax dollars. We really don't see incentive awards, certainly not many of those, certainly not across a physician practice population due to regulatory issues at play. So to the extent that someone who is not a shareholder today and is going to become a shareholder in connection with or after the transaction, we're typically seeing that done through a bonus and a buy-in with after-tax dollars.
Yeah, and I think that in the context of just how the company or the practice is taxed, that also really goes into proceeds and how those are being allocated, and also ties back into the compensation model that's created. And whether the practice is or a company's an S corporation or tax as a partnership or tax as a C corporation. There's different, pluses and minuses between those models, and all of that really ties back into how do you structure the deal, especially if you have multiple owners at different stages, and something that I think Angela and her firm in Provident works on a regular basis. So continue to type in questions. I think we're through most of these. One other item that's come up is, what's the single most important thing I can do prior to getting ready for partnering with a PE firm? I don't know, AJ, if you had any thoughts just on that, and let Angela provide her perspective as well.
Yeah, I think, there's a number of points that you could go into in terms of importance of preparation and where that should sit. I think ultimately it's important that the group is kind of open-minded to exploring this type of process. How I think about it is, more details will unfold as you go through the transaction process overall. But I think conceptually, it's important for groups to have alignment across the management team, the shareholder, and the associate pool in a lot of circumstances, to at least kind of be open-minded to hearing how the private equity investment universe could potentially benefit their business, and also being eyes wide open around the potential risks therein, especially as diligence unfolds and more information is learned about the business, and you get to the legal documents and everything else. There's more and more information that will ultimately need to be kind of transmitted to the shareholder group, that everybody needs to be aware of, and ultimately kind of getting to the point of the final vote to actually do a deal or not. But I think, some of the pitfalls and hurdles that we run into are when, let's say, the decision-making around a deal is concentrated in, let's say, one key shareholder or one, executive level function, keeping everybody else in the dark. Unfortunately, that tends to create some unfortunate situations just culturally within the business, where there isn't necessarily that level of alignment across the stakeholders to explore something collectively, and potentially, feelings of being rushed into a deal or kind of pressured into something that they weren't initially familiar with. So I think just that broadcasting of information, ensuring that the right people are in the know, and just collectively going into things eyes wide open is really important. Obviously, there's a lot of nuts and bolts that go into financial preparation, being organized and ready for due diligence, et cetera. But I think a lot of those come to naught if, at least culturally, the group isn't open and aware to some of the pros and cons of the deal.
Yeah, and AJ, I would agree with that. As I said at the outset, physician buy-in is key. Some of the transactions in the very large groups that I've seen work the best are where there's a separate PE transaction committee formed that very well may be separate and apart from the general board of directors that includes representation among geography, includes representation among age groups of physicians, that allows that committee to be involved and really educate the physicians all along the way about the process and what it means for particular groups of stakeholders. The other thing that I would say that's important to understand at the outset is valuation and expectations around valuation, particularly for larger platform transactions. Physicians are hearing about the high multiples, but my question is always, a multiple of what? And so as a result of that, we see a lot of sell side Q&A done in advance of a transaction to help educate the physicians in terms of their true EBITDA, their true valuation, and to close the gap on any potential differences in valuation with the private equity investor at the outset.
Great, good point, Angela. Well, this concludes the webinar, unless there are any other pressing questions. Everyone should be able to access our contact information. So to the extent you have questions for the Provident or Bass Berry teams, feel free to reach out. We're happy to set up a time to discuss those. But thank you everyone for joining, and look forward to talking in the future.
Thank you.
Thanks.